Variable costing is a method of cost accounting where only variable costs, expenses that change with production levels, are included in the cost of goods sold (COGS). Fixed costs, like rent or salaries, are treated as period expenses and not assigned to individual products. What is variable costing? Under variable costing, the focus is on costs that vary with production or sales. These include direct materials, raw materials used in production; direct labor, wages paid to workers producing the product; variable overhead, costs like utilities or shipping that increase with production. Example: if it costs $5 in materials, $3 in labor, and $2 in variable overhead to make one product, the total variable cost per unit is $10. Fixed costs, like $1,000 monthly rent, are not included in the product's cost. How does variable costing work? Calculate unit costs. Add all variable costs associated with producing a unit. Example: for a product with $10 in variable costs, this is the cost per unit under variable costing. Exclude fixed costs. Fixed costs, like factory rent, are recorded separately and deducted from overall profits, not assigned to individual products. Match costs to sales. Only the variable costs of the units sold are included in COGS. Unsold units' costs remain in inventory. Benefits of variable costing. Clearer decision-making. It separates fixed costs, helping managers understand how production levels impact profitability. Better contribution margin analysis. Shows how much revenue from each product contributes to covering fixed costs and generating profit. Simplifies cost behavior analysis. Helps identify how costs change with production levels. Limitations of variable costing. Excludes fixed costs in product costing. May undervalue inventory on the balance sheet since fixed costs are not allocated to unsold goods. Not GAAP compliant. Cannot be used for external financial reporting as GAAP requires absorption costing. Overlooks long-term fixed costs. Fixed costs are critical in long-term decision-making but are treated as separate expenses. Example of variable costing in action. A company produces 1,000 units with variable costs of $10 per unit and fixed costs of $2,000. Total variable costs. 1,000 times $10 equals $10,000. If 800 units are sold, the COGS under variable costing is 800 times $10 equals $8,000. The $2,000 fixed cost is treated as a separate period expense, not tied to inventory or COGS. Variable costing versus absorption costing. Variable costing. Only variable costs are assigned to products. Fixed costs are expensed in the period incurred. Absorption costing. Both variable and fixed costs are included in product costs, aligning with GAAP requirements. Quick recap. What is it? Variable costing includes only variable costs and product costs, treating fixed costs as separate period expenses. Why use it? It provides clearer insights into how production impacts profitability and helps with short-term decision-making. Limitations. It doesn't account for fixed costs in inventory, making it unsuitable for external financial reporting. Variable costing is a valuable tool for internal management, providing a clearer understanding of cost behaviors and profitability, especially for short-term decisions.